Hello, friends. I thought it might be helpful to put together a quick video and tell you why we don't try to time the market at the Chetwood Wealth Management Group, why we think it's a fool's errand, we think it's impossible to do consistently. And when I say time the market, I mean trying to get all in just before there's a big run up in the market and trying to get all out before there's a big downturn in the market. Historically, I think you will find that it is impossible to do that with any type of consistency. And I want to show you a chart that I think will back that up. So this is from one of our research partners, and it's going to show you the performance of the 500 largest companies in America, also known as the S&P 500, over a 32-year period of time. That's the purple line that you see. You can see it going up over the time. And I want to contrast that to the light blue line in this graph, because it is also measuring the 500 largest companies in America over a 32-year period of time. But the only difference between those two lines is that in the blue line, you missed out on 25 days. You missed out on the best 25 days of performance. And that 25 days out of 32 years created that giant disparity that you see. Wow. So this is part of the reason why we don't try to time the market, because I don't know when those 25 days out of the next 11,680 are going to occur. And what makes that hard is when we talk about the market, I should probably say the stock market is not just some nameless, faceless force out there. The stock market is comprised of hundreds of millions, if not billions, of individuals who all think that they are making the smart bet at the time. I mean, think about that. On every trade, there's a buyer and a seller. There's someone who is buying a company because they believe that the company is going to go up in value, and the seller thinks the exact opposite. And what makes it even harder is that the state of the economy doesn't always help, because if we learn anything from this chart that I'm going to put in front of you, it is that the market is always looking forward. The market's always trying to anticipate what is going to happen so that investors can act accordingly, and that'll ultimately be priced in. So as we're in this environment where we're experiencing the coronavirus pandemic, and there's a lot of market volatility, one of the things that we've been telling clients is that the market will recover, or should recover, historically before the economy does, because the market is looking forward. And so in the second quarter of 2020, we're expecting GDP to be largely negative. We're expecting high unemployment rates temporarily. And I think you are seeing that the market is shrugging off those numbers because those brutal statistics have already been priced in to some degree because the market's looking forward. So all that to say, we believe that it is a fool's errand to try to time when to get in or when to get out, because I don't know when those magical 25 days are going to happen, and you don't either. And anyone who says that they do are either lying or deceive themselves. So we believe it is more prudent to focus on constructing a plan around your specific financial goals and then investing with the optimal risk parameters to hit those goals. Because if we can help clients articulate those goals, hold them accountable to the prescribed means of achieving those goals, that's how we are going to add value. We're certainly not going to add value by trying to consistently guess which of the next 11,680 days are going to be the magical 25. So I hope that's helpful. Thank you for your time, and I hope you have a wonderful day.